now, the Middle East is facing just a massive energy infrastructure shock. Inflation is surging, and the global economy feels like it is practically on fire. And, by every traditional rule of finance, safe haven assets like gold should be skyrocketing as people look for shelter. But instead, gold is crashing. It's dropping right in sync with the broader stock market.
Yeah, I mean, it completely defies traditional logic, right?
Huh.
Until you actually look at the underlying plumbing of the global financial system.
Yeah.
We are watching the usual macroeconomic rules of cause and effect just break down in real time, and it is catching some of the biggest institutional traders entirely off guard.
And that is exactly the mission for today's deep dive. We are looking at a stack of recent financial, political, and geopolitical data to untangle a very messy reality. We're going to find out why the financial plumbing is acting completely backwards, why the Federal Reserve is suddenly paralyzed, and how all of this connects to the future of artificial intelligence investments.
It's just a massive web of cause and effect, and if you were listening to this right now, you are probably feeling that pinch directly. You're watching the numbers at the gas pump tick higher, maybe looking at a dip in your retirement portfolio and asking a very critical question. Is this just a temporary geopolitical blip, or are we witnessing a fundamental long-term economic shift?
Right, and our goal today is to really cut through the headline panic. We want to find the structural signal in all this noise so you can stay well-informed and actually get ahead of the curve. Okay, let's unpack this. We have to start at the literal source of the current anxiety, which is the physical disruption of the global energy grid. We are watching a tit-for-tat escalation in the Middle East that is staggering in its scale and precision.
Yeah, but trace the sequence of events. This current phase really kicked off when Israel struck Iran's South Pars gas field. And that is a massive foundational source of domestic energy for Iran.
Right.
So in retaliation, Iran struck the Qatari side of a shared gas facility, specifically targeting the Ras Laffan processing plant.
And the numbers on that Ras Laffan strike are genuinely terrifying. That attack damaged 17% of Qatar's liquefied natural gas, or LNG, export capacity. And this isn't a situation where they can just, patch a pipe and restart operations next month.
Oh, absolutely not. Rebuilding an LNG facility requires custom machine parts designed to handle cryogenic temperatures. We were looking at 3 to 5 years to repair that infrastructure, which is an absolute eternity in global energy markets. And the physical targeting didn't stop there. Iran then struck Israel's Haifa oil refinery, the largest oil processing facility in Israel. So we are seeing intentional, highly calculated strikes on the very architecture that powers the region and, by extension, the global supply chain.
The market reactions were instantaneous, too. European gas futures surged 35%. In the UK, gas costs doubled compared to pre-war levels. Over here in the U.S., fuel logistics got so tight that the government waived the Jones Act, which is a century-old maritime law, just to allow foreign-flagged ships to transport fuel between U.S. ports to keep domestic supplies moving. We even saw President Trump publicly warning Israel's prime minister not to hit any more oil and gas sites.
Right.
But here's the piece I keep getting stuck on. We know roughly 20% of the world's oil goes through the Strait of Hormuz, which is right in the middle of this conflict zone. But why isn't the U.S. panicking quite as much as Europe or parts of Asia? It's like someone knocked out the main breaker for a massive neighborhood, and everyone is scrambling for generators.
Well, what's fascinating here is how this exposes the fragile, interconnected nature of our global systems, while also highlighting a major structural shift.
Well,
The U.S. is significantly more insulated today because of the domestic shale revolution over the last decade.
okay, that makes sense.
Yet the U.S. has a degree of internal energy production that countries like Germany, Japan, or South Korea simply do not possess. They rely heavily on imports, moving through those exact maritime choke points.
But being insulated physically doesn't mean being immune economically, right?
Precisely. Because oil is a globally priced commodity, when the global supply shrinks, whether from a burning refinery in Haifa or a damaged plant in Qatar, the price for everyone goes up. Oil and gas are the foundational ingredients of the modern world.
Yeah.
They are in the fertilizer that grows the food at your local grocery store, the plastics that package your household goods, and the diesel that moves everything from an Amazon delivery van to a trans-Pacific cargo ship. When oil spikes, business margins across the globe are instantly squeezed.
Which brings us to the ripple effect. Because oil is the underlying fuel of the entire supply chain, a physical attack on a pipeline thousands of miles away instantly transforms into a domestic inflation crisis. I mean, the national average for a gallon of gas jumped 10% in just a week, hitting $3.53, with some tracking stations noting prices as high as $3.88. Crude oil spiked to $111 a barrel.
And this inflation spike is happening at the worst possible time for central banks. Jerome Powell recently stated that once adjusted for overcounting, there is effectively zero net job creation happening in the private sector right now.
So what does this all mean? Stagflation sounds like a monster from a 1970s horror movie. Is that really where we're headed, or is the media just dusting off old scary words to get clicks? Because the Federal Reserve seems effectively trapped in a devastating lose-lose scenario. Normally, when the job market stalls out and hits zero net creation, the Fed's playbook is to aggressively cut interest rates. They make money cheaper to borrow to stimulate business expansion and get companies hiring again.
But they can't touch the interest rates. Because at the exact same time the job market is stalling, this Middle East conflict is sending oil-driven inflation through the roof. If the Fed cuts rates to save the job market, they pour gasoline on the inflation fire.
Right. If
they raise rates to kill the inflation, they crush an already fragile job market. So the Fed voted to keep benchmark rates unchanged, sitting frozen at 3.25 to 3.5%. They effectively canceled the rate cuts the market was banking on.
And it is a global paralysis. The European Central Bank is holding at 2%. The Bank of England is holding at 3.75%. They're all just sitting on their hands, which brings up this macroeconomic concept that keeps appearing in the data: stagflation. High inflation occurring simultaneously with high unemployment and weak economic growth.
Yeah, and the fear of stagflation is mathematically justified right now. Historically, since 1960, a true devastating stagflation scenario has only happened once in 1973, following the OPEC oil embargo.
Yeah.
It is incredibly rare because it requires a sustained massive spike in energy prices alongside a weakening underlying economy.
Right.
But those specific ingredients are currently sitting on the counter. Central banks are paralyzed, forced to just wait and hope the geopolitical tension resolves itself before the structural damage becomes permanent.
But while the central banks can afford to wait, voters definitely do not have that luxury. When everyday costs rise so visibly at the grocery store and the gas pump, a macroeconomic problem instantly mutates into a massive political battle.
We're seeing that materialize in the polling data immediately. The political cost of living is proving to be a really heavy anchor.
The numbers tell a very stark story. President Trump's net approval rating specifically on the issue of the cost of living is currently 41 points underwater. And with independent voters, it is 60 points underwater. That is a 71-point swing in the wrong direction since October 2024. Vice President J.D. Vance recently framed these price hikes as a, quote, temporary blip caused strictly by the Middle East conflict, arguing that once the war settles, prices will drop.
But that domestic messaging is colliding head-on with a massive new request from the Pentagon. The Department of Defense is asking for a $200 billion supplemental funding package to sustain military operations and support the war effort involving Iran.
This has triggered an intense, polarized debate, and we really have to examine the core arguments driving both sides. On the left, commentators are pointing out the staggering opportunity cost of that $200 billion. They argue that this exact amount of money could fund free college for Americans, provide $10 a day childcare, or build 1,000 new trade schools.
Sure.
The argument is that everyday citizens are struggling with crippling inflation, and yet vast resources are being authorized for overseas conflicts. It's like putting a massive unexpected home renovation on a high-interest credit card while you're already struggling to pay the weekly grocery bill. The friction there is immense.
Conversely, on the right, commentators are arguing that this spending is an absolute non-negotiable necessity. They point out that the U.S. has severely depleted its ammunition stockpiles by supplying allies in previous conflicts like Ukraine. Their stance is that replacing those munitions is critical for baseline national security, and that $200 billion is a small price to pay to maintain military readiness and fundamentally prevent Iran from becoming a nuclear power.
Right. And this raises an important question about the actual mechanics of how this gets paid for, because it directly impacts the listener. Due to the current makeup of Congress, passing this $200 billion would likely require using a legislative process called reconciliation. And the strict rule of reconciliation is that it must be revenue neutral.
Meaning the government cannot simply print the money or add it to the national deficit blindly. This raises an important question about priorities. If Congress wants to spend $200 billion on the military through reconciliation, they must legally find $200 billion in cuts somewhere else in the existing federal budget.
And this is where the abstract cost of war becomes incredibly tangible for the average citizen. Pulling $200 billion out of a domestic budget means freezing federal highway grants, pausing infrastructure projects in your state, or cutting specific community development funds.
Yeah.
It forces a direct, unavoidable legislative showdown between funding domestic economic programs, which voters are demanding relief for, and funding long-term geopolitical military strategy.
It creates immense friction. The voter feels the pain of inflation daily, while the benefits of global military readiness are largely invisible to them until a crisis actually hits.
Okay, so we have physical pipelines burning, inflation spiking, central banks frozen, and a $200 billion political knife fight brewing over budget cuts. If you look at traditional financial logic, in a world that chaotic, safe haven assets should be skyrocketing.
You think so?
Right. People usually flock to gold when the global dashboard is flashing red. But here's where it gets really interesting. If the world is practically on fire, why is gold dropping? It feels completely backwards. Are traders just totally misreading the room? Because gold didn't just dip, it gapped down.
And that technical movement is crucial to understand.
For anyone unfamiliar with the term, gapping down means the price dropped so violently overnight that there were literally no buyers in between yesterday's closing price and today's opening price. It just fell through the floor. It smashed right through the 50-day and 100-day moving averages, which are the psychological safety nets that technical traders rely on. Gold is dropping right in sync with the stock market.
This raises an important question about the plumbing of the global financial system. What we are witnessing is the violent unwinding of something called the short dollar trade, and it is purely mechanical.
I'm looking at the mechanics of this short dollar trade, and it seems like a massive systemic trap. For a long time, traders have been heavily leveraged, essentially borrowing dollars to buy other assets like gold or tech stocks, expecting the dollar to get weaker over time.
Right.
The idea is you pay back the borrowed dollars later when they are worth less. But if stagflation hits, doesn't commercial lending freeze up, actually making the dollar stronger?
You have hit the exact mechanism causing the crash. How are U.S. dollars actually created in the global system? They're mostly created through commercial bank lending. When a bank issues a loan to a business to buy inventory or build a new factory, new dollars enter the financial system. But in a stagflation scenario, prices for materials go up, consumer demand goes down, and interest rates remain stubbornly high.
So businesses start taking out loans to expand.
Exactly. Commercial lending drops off a cliff. When lending drops, fewer new dollars are created. And when the supply of new dollars shrinks, the dollars that are already circulating suddenly become scarce and therefore more valuable. The dollar actually gets stronger against other currencies.
Oh, wow. So all those highly leveraged institutional traders who borrowed billions, betting the dollar would get weaker, are suddenly caught completely off guard.
They're getting brutally margin called. The asset they owe the U.S. dollar is getting more expensive by the minute, while the global geopolitical panic is making their actual investments drop. To cover their positions and avoid total bankruptcy, they are forced into a fire sale. They have to liquidate absolutely everything.
Jeez.
They sell their tech stocks, and yes, they sell their gold, just to scrape together enough U.S. dollars to cover their debts.
That completely flips the narrative. The drop in gold isn't a commentary on gold losing its intrinsic value as a safe haven. It is a mechanical plumbing issue caused by forced institutional liquidations. And for you listening, this is a crucial warning not to panic sell your retirement portfolio just because Wall Street traders are facing massive margin calls. Their panic is mechanical. Your strategy should be structural.
Relying on data over panic is the only way to navigate this. If we step back and look at the historical context, the current stock market pullback is remarkably normal. A 10% market drop happens, on average, every 18 months.
So it's a bit like turbulence on a flight, terrifying in the moment, but it rarely brings the plane down. Instead of staring at the altimeter in panic, you're saying we should be looking at where the plane is actually going, like these AI memory chips.
That is a highly accurate way to visualize it. The Carson Group recently crunched the numbers on 40 major geopolitical events over the last 85 years. What they found is that, on average, the S&P 500 only loses about 0.9% in the first month, following a major geopolitical shock.
Okay.
But over the subsequent 6 months, as the initial panic fades and the market digests the new reality, the index typically rises 3.4%.
And we are seeing concrete signs of stabilization beneath the headline panic. Look at the housing market. Inventory of single-family homes has essentially doubled since 2022. Because high mortgage rates have cooled off frantic buyer demand, prices are finally flatlining instead of crashing. It is actually becoming the most balanced housing market in a decade, giving buyers room to negotiate without the frenzy. Even Bitcoin is showing surprising stability right now, largely because long-term holders simply refuse to sell, creating a hard floor underneath the price.
If we connect this to the bigger picture, you have to ask where smart capital is positioning itself for the next decade. If physical commodities like oil are this vulnerable to geopolitical shocks, forcing traders to liquidate assets just to survive, where is the structural wealth hiding? It is fleeing the physical supply chain entirely and moving into the digital one, which is AI infrastructure.
Everyone focuses on the software, right? The consumer-facing large language models like ChatGPT. But the real opportunity lies in the physical hardware required to run them, the picks and shovels of the artificial intelligence gold rush.
Artificial intelligence is currently evolving from basic text chatbots into autonomous agents and eventually physical robotics. That evolution requires an exponentially larger amount of memory to process actions in real time. We talk constantly about the electrical grid being an energy bottleneck for AI data centers, but the next massive, unavoidable bottleneck is the memory chips themselves.
Think of AI processors, the GPUs everyone talks about like the massive engine of a sports car. The memory chips are the fuel pump. It does not matter how fast and powerful the engine is if you cannot pump data into it fast enough to keep it running. That is why highly advanced memory, specifically DRAM and high bandwidth memory, is the critical bottleneck for the entire AI industry.
And the competitive landscape for producing that memory is incredibly concentrated. The global production of these highly advanced chips is controlled by essentially three companies: Micron, SK Hynix, and Samsung. Together, they control roughly 90% of the entire global market.
Wait, really? And this is not an industry a startup can just jump into tomorrow to compete, right?
Not at all. The capital expenditure required to build a single fabrication plant for these chips is astronomical, often running into the tens of billions of dollars. You need massive clean rooms, specialized extreme ultraviolet lithography machines, and decades of proprietary engineering knowledge.
Oh, wow.
You cannot just spin up a factory. These three companies have a solid 5 to 10-year moat against any serious new competitors simply because of the physical and financial barriers to entry.
So while the entire world is understandably hyper-focused on the current oil shock and the burning refineries in the Middle East, the structural wealth of the next decade is quietly being built on this massive pivot toward AI memory demand. Consistency beats panic. The long-term investor is looking at the 10-year demand curve for high-bandwidth memory, not the 10-day forced liquidation of gold.
The daily headlines demand your fear, but the structural data rewards your patience.
What a journey this deep dive has been. We started with a physical missile strike on a gas facility in Qatar. We watched the mathematics of that strike ripple into a 10% jump at your local gas pump. We saw how that resulting inflation completely paralyzed the Federal Reserve, trapping them between saving jobs and fighting prices. We unpacked the $200 billion political showdown over how we fund domestic needs versus military strategy, watched a hidden currency squeeze force massive liquidations in the gold market, and finally found the long-term structural pivot hiding in the background, the AI memory chip monopoly.
It highlights just how deeply intertwined the physical and digital worlds have become. You simply cannot isolate global geopolitics from your local grocery bill or your retirement account.
Which leaves us with one final thought to ponder as you go about your week. We spent a lot of time today analyzing how vulnerable the global economy is because of our reliance on a physical resource, oil, that must travel through highly contested geopolitical choke points. But as we pivot our entire future toward artificial intelligence and massive data centers, what happens when the digital supply chain faces its own global shock? If the critical memory chips required to run the future are controlled by just three major companies, largely located in their own geopolitically sensitive regions, are we actually solving our economic vulnerabilities? Or are we just trading our dependence on one fragile physical resource for an equally fragile digital one?
It is a dynamic that redefines systemic risk entirely.
Until next time, keep looking past the dashboard.